Brace yourself for an in-depth analysis of what lies ahead for the economy. Experts discuss a crypto bull run, the significant impacts of upcoming elections, and the end of the petrodollar deal. AI stocks may skyrocket, but is hyperinflation around the corner? Get ahead of market shifts with insights from leading thinkers and leverage AI for strategic investing. Today, on Financial News in Review, we will summarize the following videos. From Blockworks Macro, we have the bull market in stocks and crypto will continue as liquidity resurges, Joe McCann. From Blockworks Macro, we have how the 2024 election will rock markets, a quarter up 100% in 1 year, Citrini. From Kitco News, we have Petrodollar deal expires, why this could trigger collapse of everything, Andy Schectman, part 1/2. From Kitco News, we have recession delayed, not derailed, as economy approaches tipping point, David Rosenberg. From David Lynn, we have what happens to stocks when concentration bubble pops, Michael Gade. From David Lynn, we have India to surpass US in 25 years, says India's ex-chief economist, Krishnamurthy Subramanian. From Oxbow Advisors, we have Ted Oakley, Oxbow Advisors, interview series, June 17th, 2024. In this episode of Blockworks Macro, the host sits down with Joe McCann, the founder and CEO of Asymmetric Fund, to discuss why he believes the bull market in stocks and crypto will continue as liquidity resurges. As a seasoned trader and technologist with over 24 years of experience, Joe offers a unique intersectional perspective on macroeconomics and cryptocurrency. His background and the extensive expertise of his trading partner in global macro strategies lend significant credibility to their insights. Though it's worth noting their operational focus is on digital assets, which may introduce a degree of bias towards viewing crypto as a favorable investment environment. The core thesis of the video is that the liquidity conditions and macroeconomic factors strongly suggest a continuing bull market in both stocks and cryptocurrencies. Joe believes that global liquidity, which influences risk assets, has bottomed out and is set to increase. This, alongside potential rate cuts from the Federal Reserve, underpins his outlook for a robust market performance into the year-end and beyond. Here are the key points discussed by Joe McCann. Macroeconomic conditions. Joe explains that the dual mandate of the Federal Reserve has started to show cracks in the employment data, suggesting future rate cuts. He cites that global liquidity has bottomed in October 2022 and will likely increase, driven by an improving economic environment. Crypto and macro integration. Asymmetric's strategy leverages macroeconomic trends to invest in digital assets with the perspective that getting the macroeconomic conditions right translates to getting crypto right. The firm went long on crypto in December 2022 when global liquidity appeared to stabilize. Market predictions and risk assets. Joe expects the digital asset market to rise along with broader risk assets as liquidity improves. He mentions liquidity-based idiosyncrasies within the crypto market, such as thin spot volumes affecting price movements. Joe McCann made the following predictions. Upcoming rate cuts. Joe predicts at least 2 rate cuts by the Federal Reserve before the end of the year. He even suggests the possibility of a 50 basis points cut in July, depending on economic data. Evidence includes the observed shift in employment data, the Federal Reserve's dual mandate, and the influence of election cycles. Second half market performance. Joe anticipates a significant market rip into year-end, particularly post-election as the market seeks certainty. He predicts Bitcoin dominance peaking in Q3, followed by a resurgence in altcoins, with Bitcoin potentially resuming its rally in Q4. Joe McCann concludes that aligning one's investment strategy with macroeconomic indicators provides a clear advantage, particularly in volatile markets like crypto. He strongly believes that the next wave of liquidity will buoy risk assets, further enhancing the appeal of digital assets. He advises maintaining focus on liquidity trends and macroeconomic policies to optimize investment outcomes. Additionally, he mentions the crucial role of embracing tech-driven financial innovations within the crypto sector. Welcome to Blockworks Macro. Today we have a special episode featuring Citrini, a stock picker and trader who has been on the show twice before. Over the past year, Citrini has achieved impressive results, with his AI investment basket up 60 to 70% and his overall index gaining 100%. In this episode, we'll dive into how the upcoming 2024 election will impact the markets and discuss Citrini's expert take on this crucial topic. The core thesis of today's discussion revolves around the significant impacts that the 2024 U.S. election will have on markets. Citrini argues that whether Trump or Biden wins, the elections will create distinct market shifts, influencing trade, tax policies, defense sectors, and specific industries like AI and automation. These shifts necessitate preparedness to capitalize on market opportunities and mitigate risks. Here are the key points discussed by Citrini: current market sentiment. Citrini acknowledges signs of caution in the market, despite being a bullish investor historically. He highlights various macro concerns, including potential economic slowdown, unemployment rate trends, and household saving rates. Thematic baskets. Citrini has split his investments across several thematic baskets, including AI, fiscal beneficiaries, and geopolitical plays. In AI, companies like NVIDIA and SMCI lead the charge, but he's also diversified to mitigate single stock risks. For fiscal beneficiaries, he focuses on stocks benefiting from government spending and infrastructure projects. Election impact on markets. Citrini has constructed baskets to play both potential election scenarios, a Trump or Biden win. He predicts market volatility around the election, with Biden likely to support nearshoring and tax hikes, while Trump may champion aggressive onshoring and tariff policies. Citrini made the following predictions. Market volatility. Citrini anticipates significant market volatility around the election dates, driven by partisan policies on trade and taxation. Rising Trump odds could boost European defense stocks at the expense of U.S. defense companies. Interest rate cuts. Citrini predicts an epic steepening of the TW10 spread if Trump wins, driven by political pressure on the Federal Reserve to cut rates, while inflationary policies drive long-term rates up. AI and automation. Regardless of the election outcome, Citrini sees a continued push towards AI and automation, with substantial investment required in advanced manufacturing and industrial automation equipment. Citrini concludes that preparedness and strategic positioning are key to navigating the upcoming election. Whether Trump or Biden wins, specific industries will benefit, while others could face challenges. Investors should focus on thematic baskets that align with election-driven policies and macroeconomic trends. Key actions include diversifying into stocks that could benefit from fiscal policies and monitoring geopolitical developments closely. Welcome to Kitco News. In this enlightening segment, we dive deep into a captivating discussion with Andy Schectman, president and owner of Miles Franklin Precious Metals. Michelle McCory hosts this critical conversation covering the expiration of the pivotal Petrodollar deal and its monumental implications for the global economic landscape. The core thesis of the video revolves around the expiration of the Petrodollar deal between the U.S. and Saudi Arabia, which could undermine the U.S. dollar's status as the world's reserve currency. Schectman contends that this development could set off a chain reaction leading to hyperinflation, a skyrocketing interest rate, and widespread economic instability, ultimately triggering the collapse of everything. Here are the key points discussed by Andy Schectman. Impact of expiration of the Petrodollar deal. The Petrodollar deal, initiated in 1974, required that oil exports be priced exclusively in U.S. dollars. Saudi Arabia's decision to end this 50-year-old agreement marks a significant shift in global economic dynamics. With oil no longer exclusively priced in dollars, less demand for the dollar globally could trigger its devaluation and return in large quantities to the U.S. Saudi Arabia's economic moves. Saudi Arabia has joined China's Project mBridge, a digital currency cross-border payment system, moving further away from the U.S. dollar. The BRICS, Brazil, Russia, India, China, and South Africa, countries reiterated calls for de-dollarization at their recent meeting, pushing trade using their own currencies. China has been selling U.S. treasuries and buying gold, indicating a strategic shift away from dollar assets. Consequences of de-dollarization. As foreign-held dollars return to the U.S., inflation rates will escalate. A massive influx of dollars could cause hyperinflation, prompting a significant interest rate hike to counteract the depreciated dollar value. Higher interest rates could cripple the overleveraged U.S. banking system, stock market, and economy. Andy Schectman made the following predictions. Hyperinflation. If countries flood the market with US dollars, hyperinflation will ensue due to the sudden increase in the dollar supply. Increased interest rates. Interest rates will spike dramatically in response to hyperinflation, exceeding the current thresholds that banks and insurance companies can withstand. Economic collapse. The combination of hyperinflation and high interest rates could lead to a collapse of major economic pillars, including the stock market, bond market, banking system, and insurance companies. Andy Schectman concludes by emphasizing the severity of the situation post-petrodollar deal expiration. He urges viewers to be cautious, diversify their portfolios, and consider investments in precious metals like gold, citing their historical stability and lack of counterparty risk. Schectman profoundly reiterates that the era of fiat currencies appears to be coming to an end, making tangible assets a safer bet in these uncertain times. Welcome to Kitco News, your go-to source for insightful economic analysis. Today we have the pleasure of featuring David Rosenberg, a senior economist at Rosenberg Research with a track record for accurate market predictions. The core thesis of Rosenberg's analysis is that the anticipated recession has been delayed but not derailed. He emphasizes that the economy is at a tipping point, with numerous signs pointing towards an inevitable recession despite recent economic resilience. Here are the key points discussed by David Rosenberg. Consumer spending and retail sales. U.S. retail sales only increased by 0.1% in May, indicating consumer spending is pulling back amid ongoing inflation and a weakening job market. Weak sectors such as furniture, despite discounts, show a significant dip, further reflecting a struggling consumer base. Evidence presented includes historical retail sales data and current consumer confidence indices. Fed's interest rate strategy. Rosenberg points out that the Federal Reserve's strategy might be disconnected from economic reality, echoing past lags between policy changes and their economic impacts. He draws a parallel to 2007 when delayed recession predictions were eventually proven accurate, suggesting a similar pattern could be unfolding now. Fiscal stimulus and economic health. Last year, the U.S. economy experienced growth due to non-recurring events, a 25% expansion of fiscal deficit, robust credit card growth, and excess savings. With these factors no longer supporting the economy and rising credit card default rates, economic health looks precarious. Political and global comparisons. Comparing the U.S. to Canada and Europe, Rosenberg highlights that despite their different approaches, the underlying economic pressures are similar, but manifest differently due to structural variances in fiscal policies and mortgage markets. David Rosenberg made the following predictions. Inevitable recession. Rosenberg predicts an inevitable recession driven by lagging impacts of Federal Reserve policies and the absence of fiscal stimuli that previously buoyed the economy, supported by consumer spending data, credit market trends, and historical parallels to past economic downturns. Rate cuts by 2025. Despite its current stance, Rosenberg anticipates the Federal Reserve will cut rates significantly later this year into 2025 as economic conditions continue to weaken. Evidence includes comparisons with other G7 nations and the U.S. housing market's unique 30-year fixed-rate mortgage dynamic. David Rosenberg wraps up by emphasizing the cyclical nature of the economy and the necessity for caution. He advises diversifying investments and being prepared for a recession, which he sees as inevitable due to the fundamental economic indicators currently in play. In this insightful episode on the David Lynn channel, host David Lynn invites Michael Gade, the renowned publisher of the Lead Lag Report, for an in-depth discussion on what happens to stocks when the concentration bubble pops. The conversation covers various market dynamics, including the state of large-cap stocks like NVIDIA, the performance of small caps, and broader economic indicators. The core thesis of the video is based on Michael Gade's assertion that the current concentration bubble, especially around large-cap tech stocks like NVIDIA, is unsustainable. He discusses two potential scenarios for the market. Either large caps will face a significant downturn, or small caps will catch up. Gade leans towards a more pessimistic outcome, predicting a market resolution on the downside due to unanticipated market corrections and economic slowdowns. Here are the key points discussed by Michael Gade. Market concentration and NVIDIA's role. NVIDIA has recently surpassed Microsoft in market cap, largely driven by the AI boom. The market's heavy dependence on NVIDIA and a few other large-cap tech stocks creates a concentration bubble. Historically, such concentration has been a precursor to market corrections. Yields and economic indicators. Yields have been falling, but not necessarily due to AI developments. Economic slowdowns and retail sales have more influence. The decline in yields could signal disinflation or an upcoming credit event. Broader market risks. Utilities and gold have been underperforming, signaling a defensive market posture. The breakout in gold and underperformance in utilities suggest potential risk-off conditions. Small caps and economic indicators. Small caps in other sectors like biotech and energy remain depressed, hinting at underlying economic issues. Lumber-to-gold ratio declines, highlighting a slowdown in construction and housing. Michael Gade made the following predictions. Large cap correction. Gade anticipates a significant downturn in large cap stocks like NVIDIA, potentially dragging down the entire market. This downturn may be sparked by unanticipated economic shocks or a realization of the overvaluation in tech stocks. Credit event and economic slowdown. Gade foresees the risk of a credit event, possibly originating from Japan's reverse carry trade dynamics. Such an event could exacerbate economic slowdowns and result in broader market corrections. Potential small cap rally. While less likely, Gade acknowledges a scenario where small caps may rally, catching up to their large cap counterparts. Michael Gade concludes with a cautious outlook, stressing the risks associated with the current market concentration in large cap stocks like NVIDIA. He advises investors to diversify into sectors like energy, uranium, and biotechs, which have been lagging but present substantial growth potential. Despite the cautious tone, Gade remains optimistic about certain long-term investment opportunities outside of tech. Get ready for an eye-opening session on David Lin's channel as we dive into the future of the global economy with our esteemed guest, Krishnamurthy Subramanian. With an impressive background as the former chief economic advisor to the government of India and now the executive director for India, Bangladesh, Sri Lanka, and Bhutan at the International Monetary Fund, IMF, Krishnamurthy Subramanian brings deep insights into India's economic trajectory. Be prepared for fascinating projections and analyses grounded in his new book, India at 100, Envision Tomorrow's Powerhouse. In this insightful interview, Krishnamurthy Subramanian presents a bold and ambitious picture of India's economic future. He argues that by 2047, India will surpass the United States to become the world's second-largest economy, powered by sustained annual growth rates of around 8%. He suggests that key economic reforms, favorable demographic trends, and strategic initiatives like Make in India and digital infrastructure enhancements are set to catapult India into a global economic powerhouse. Here are the key points discussed by Krishnamurthy Subramanian. Macroeconomic performance. India's impressive GDP growth of 8.2% last year contrasted with a sluggish global economy. The country's success in maintaining moderate inflation despite global supply chain disruptions, particularly from the Ukraine war. Political stability and economic policies. Re-election of Prime Minister Narendra Modi symbolizing continuity in economic policies. Emphasis on infrastructure such as roads, railways, and power supply, contributing to reduced logistics costs and better manufacturing competitiveness. Make in India initiative. Significant reforms in land, labor, and capital markets since 2014. Foreign investments encouraged by production-linked incentive schemes resulting in substantial job creation, notably Apple's decision to manufacture 25% of its iPhones in India. Digital infrastructure, creation of over 500 million new bank accounts used for direct transfer of welfare benefits, significantly reducing pilferage and increasing efficiency. Socioeconomic growth and welfare projections of GDP per capita growth leading to a 7- to 8-fold increase in the next 3 decades. Welfare programs targeted through digital infrastructure enhancing inclusivity and creating a large middle class. Krishnamurthy Subramanian made the following predictions. India's economic growth. India will maintain an 8% annual growth rate in real terms until 2047, making its economy worth $55 trillion by then. Key assumptions include a reduction in rupee depreciation, stable inflation, and increased productivity. Sectoral shifts. Manufacturing's share of GDP will increase to 25%, while agriculture's share will decrease. Services and high-tech industries, already robust, will continue to be growth leaders. Krishnamurthy Subramanian concludes with a resounding note of optimism, encouraging watchers to look at India's economic growth as a significant global opportunity. He emphasizes strategic investments in manufacturing, technology, and infrastructure as key drivers. His predictions also include a call to global investors to tap into the high growth potential. For viewers, he advises monitoring India's policy reforms closely, as these are pivotal to sustaining projected growth rates. Welcome back to Oxbow Advisors. Ted Oakley, managing partner, hosts an in-depth conversation with Danielle DiMartino Booth, the CEO and chief strategist of Quill Intelligence. Today, they'll dive into what lies ahead for the U.S. economy, touching on topics from job markets to upcoming recessions and the current banking system's condition. Danielle, known for her extensive writing and sharp economic insights, holds no bars back. Join us for an eye-opening discussion. The core thesis of this interview revolves around an imminent recession, already in effect since late 2023, and the severe economic and market implications that follow. Danielle argues that despite mainstream media's portrayal of a robust job market, underlying data points, such as declining job figures and rising non-performing loans, paint a different, more troubling picture. Here are the key points discussed by Danielle DiMartino Booth. Job market realities. Danielle reveals that data shows a deteriorating job market, contradicting the official positive reports. According to her, the real employment numbers have been misrepresented with actual job losses instead of gains. Gaslighting of public perception. Job seekers and recent graduates face a harsh reality with fewer job opportunities, often not aligning with traditional economic indicators. Banking and financial systems. The current banking system's condition is worse than perceived. Rising charge-off rates in commercial real estate surpass those seen in the lead-up to the 2008 financial crisis. Banks are reaching their leverage limits, with extensive lending commitments exhausting their ability to issue new loans, leading to potentially severe credit crunches. Household economics. Households are experiencing a significant decline in real income with increasing financial pressure, highlighting stark disparities in economic well-being between different societal strata. Rising debt levels among consumers who can no longer sustain their standard of living without resorting to extreme borrowing measures, such as buy now, pay later schemes for everyday expenses. Danielle DiMartino Booth made the following predictions: recession duration and impact. Danielle predicts that the recession, already in effect since late 2023, will continue deepening with severe economic implications. Financial pressure on households will escalate as loan defaults rise, particularly in the housing and commercial real estate markets. Federal Reserve movements. The Federal Reserve, currently maintaining high interest rates, might cut rates around the end of the year, but not before significant economic damage occurs. Even with rate cuts, a notable economic rebound is unlikely as fundamental issues and non-performing loans persist. Danielle DiMartino Booth concludes by emphasizing the importance of economic preparedness and cautious financial planning. Institutions and individuals must brace for prolonged economic challenges, including potential downturns in stock values and continued strain on consumer finances. Diversifying into safe assets like bonds and possibly gold stands as vital advice. In the face of upcoming elections, these economic issues will undoubtedly steer political and fiscal policies, impacting markets and households alike. Stay informed and be prepared for the economic road ahead. Across these videos, our experts presented varying takes on the economy's direction. Joe McCann remains bullish on crypto and stocks due to rising liquidity, while Citrini focuses on the market volatility triggered by the 2024 election. Conversely, Andy Schectman warns of an economic collapse stemming from the Petrodollar deal expiration. David Rosenberg predicts an inevitable recession despite current resilience. Both Gade and Subramanian highlight key risks and growth potential in different sectors. Whether you're preparing for a bull run or bracing for a downturn, stay informed and strategically positioned. Thanks for watching Financial News in Review for June 19th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see, drop a comment below. See you next time.